This presentation is divided into 4 parts. First of all, we need to understand what is international bond investment. International bond investment refers to the investment in bonds that are either denominated in a foreign currency or issued in foreign markets. This type of investment offers opportunities for diversifying an investment portfolio and may provide different rates of return and risk levels compared to the domestic bond market. International bonds can originate from various governments, multinational corporations, or international organizations. International bond investments provide investors with opportunities to tap into global markets, but also require consideration of additional risks and complexities. Properly managing this risk can make international bonds a valuable part of an investment portfolio. Second, let's explore the motivation to invest in the bonds of other countries. I think it mainly includes the following 5 motivations, and these motivations help investors gain a more comprehensive understanding of and balance in their investment portfolios, adapting to the complexities of the international financial environment. Next is the focus of the presentation. When considering the purchase of a bond issued by another country, several factors need to be taken into account. When calculating the expected return of the investment, here are 6 key considerations that I think. The bond's coupon rate, which represents the interest paid by the issuer, is a critical factor. Higher coupon rates generally result in higher returns, but they must be considered in relation to prevailing interest rates. Inflation erodes the real value of money over time. Consider the inflation rates in both the country of the bond issuer and your home country. Higher inflation rates in the issuer's country may reduce the purchasing power of the interest and principal repayments. Yield to maturity is the annualized rate of return earned on a bond held until its maturity date. Is a key indicator for assessing the value of a bond investment, as it incorporates the bond's price, coupon rate, payment frequency, and remaining time to maturity. The returns on bonds denominated in foreign currencies are directly affected by exchange rate fluctuations. If the investor's home currency depreciates against the bond's currency, the bond's returns increase when converted back to the home currency. When the home currency depreciates, the returns on these investments increase upon conversion. Thus, exchange rate movements are a significant factor, affecting the returns on investments in foreign currency assets. Ratings from credit rating agencies provide an indication of the issuer's ability to meet its debt obligations. Higher credit risk is typically associated with higher potential returns, but it also increases the likelihood of default. An increase in market interest rates leads to higher rates for newly issued bonds, and a decrease in the market value of existing bonds. Interest rate risk has a greater impact on long-term bonds than on short-term bonds. Understanding market interest rate trends is crucial for developing bond investment strategies. In this presentation, we have delved into various aspects of international bonds investment, including the coupon rate, yield to maturity, and the impacts of exchange rate fluctuations, and how they collectively influence investment returns. By understanding these key concepts, investors can better assess and manage the risks and opportunities associated with international bonds, making more informed investment decisions.